Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be going over UnitedHealth stock once again, and the biggest reason for this is because somebody just bought UnitedHealth after a long time of having a hidden investment, and that person is Warren Buffett. Warren Buffett just released his 13F filing, which every super investor releases what companies or stocks they're buying during each quarter. And as we can see here, UnitedHealth just revealed a position in UnitedHealth, which is only 0.6% of its portfolio. But with that being said, it's worth $1.5 billion, and he has over 5 million shares of UnitedHealth. And he just recently bought this over the past quarter. So this is a big deal for UnitedHealth. And going over to the stock, we can see the stock is up over 6% after hours, and in the past 5 days it's up 10%. With including after hours, it's up almost 17%. So this stock has really been on a roll, and now we can see after hours it's actually up to $294. The stock is up almost 10% after hours because of the news that Warren Buffett has just bought into UnitedHealth. As we can see here, year to date though, the stock is still down a whopping 46%, but nonetheless Warren Buffett is seeing something in this company. So going over here, we can see why is United Healthcare going down so much. As we can see here, the main reason is the surgical medical costs and margin compression. So the medical loss ratio rose to 89.4%, which was a 4.3% increase from 2022 and was well above expectations, in which their all-time high was actually only about 84 or 85%, around that area. So this rose to all-time high medical costs, reducing the profit margins in UnitedHealth. So this is the reason for the bad performance. Also, these cost overruns led to reduced operating margins and prompting a sharp cut in 2025 earnings guidance from $30 a share to at least $16 a share, or $20.64. So also the disappointing earnings and financial forecast is another reason for these results. EPS is continuing to decrease each quarter as of this year. And then another reason is the DOJ investigation and regulatory risks, where a criminal probe into Medicare Advantage billing practices include DOJ interviews with doctors and ex-employees. The company also faces $1.6 billion in potential legal settlements tied to federal investigations. So this company is tied up in some legality issues, in which basically the DOJ is investigating if they over-exaggerated patients' illnesses or basically medical history to where they actually got more money than they probably should have if they actually did it. But they don't know yet, so that doesn't mean anything right now. But let's go over here, in which I think the reason for Warren Buffett, this is a pretty similar situation for when Warren Buffett actually bought American Express. So this is a pretty good comparison. When Warren Buffett actually bought American Express back in the 1960s, which was the salad oil scandal, where American Express had extended loans against falsified inventory, causing significant losses and a sharp decline in its stock price. Despite the panic, Buffett saw the enduring strength of the brand and acquired a small stake in the company in 1964, in which the stock between November 20th to December 2nd dropped from $61 to $40 and got all the way to $35, a drop of 43%. Does this sound kind of similar to UnitedHealth, which they have a scandal going on right now with their Medicare Advantage plans, in which the stock is now down? UnitedHealth 46%. American Express was down a lot. If you didn't know, American Express basically were getting loans from this company that were falsifying whether they had oil, in which they actually didn't have oil. So basically, it was just a complete scam in which American Express was investing in. So Warren Buffett saw a huge opportunity in American Express and kept buying this company, and it's still one of his largest positions in his portfolio. So I just thought that this was a pretty good similarity between American Express and UnitedHealth, where right now UnitedHealth's in a pretty bad situation market sentiment wise, and they're in some investigations in which, similar to American Express, Warren Buffett bought during these times. Taking a look at this investigation of UnitedHealthcare, we can see this is the largest Medicare Advantage plan program, in which UnitedHealth is actually facing a federal civil fraud investigation into records diagnosis that lead to extra payments for its Medicare Advantage plans. Like I said, they're trying to get more money for potentially, it's not proven yet, that they falsified how bad people are sick and how much money they need for extra payments. So with that being said, taking a look at the financial health of UnitedHealth, the revenue is continuing to grow over time, so this is a good thing with this company, but that's not the biggest worry, it's the earnings per share. Taking a look at the earnings per share for UnitedHealth, we can see over time it was increasing until this year. This year we've seen huge decreases in earnings per share. We saw almost a 50% decrease in this last quarter over quarter. And then the next quarter we're expecting an even greater decrease. This decrease is almost 60% decrease in earnings per share. So that's why the stock is down nearly 50% year to date because of the earnings per share decrease. Taking a look at the last earnings call, in which we actually had some highlights where the revenue growth, like I said, growing at 13% is a very good revenue growth rate, especially for such a large company. Also, the client retention at Optum RX continues to grow, and then the commitment to reform and performance. This company is trying to commit to becoming more profitable in the future, because this is the biggest problem with UnitedHealth right now, is the lack of profitability and decreasing profit margins, where their medical expenses are just too high as of late, where they messed up the timing of their pricing, but now they're in the future, they're trying to turn this around. But here are obviously the negatives. Like I said, Medicare pricing and cost challenges. The company faced a $6.5 billion increase in medical costs, with $3.6 billion in Medicare and $2.3 billion in the commercial business. Also, Optum Health performance is declining. Medicaid trend pressures are hurting this company, and value-based care margin compression. So overall trends in the health insurance industry is very similar to basically every company. Look at every company that is in the same sector, like Elevance Health, Centene, Molina Healthcare. All these healthcare companies are facing these trend pressures where the pricing is really high and their expenses are insanely high, resulting in decreasing margins. So that's the main problem. And taking a look at the profit margin for United Healthcare, as we can see over time, it was increasing, but we saw a huge decrease in 2024. This was the 2025 profit margin, but as of its recent quarter, it actually is all the way down to 3%. So that is the biggest problem, is the profit margin in spending with United Health. But the thing I like, and what Warren Buffett probably saw in this company, is the increase in buybacks. Warren Buffett is a huge advocate for buybacks, in which UnitedHealth just last quarter had one of its highest buyback rates basically in the past 5 years. They bought back 2% of their shares just last quarter. So this shows confidence in the company, that they're still thinking that in the future it still looks good for the company. And I think this looks really good for UnitedHealth that they're buying back, because if you didn't see them buying back, I would be worried about the management confidence in this company going forward. Now, taking a look at my 7-step stock analysis, these are the 7 key metrics that I like to look at, and I actually get 5 out of the 7 key metrics for UnitedHealth. This shows us a good overview of the financial health. First 2 are the valuation metrics. The first is the trailing PE ratio, which is 11. Normally, we want this less than 30 or in line with the market. As we can see here, it's greater than 0, though. This is the benchmark for me. I just wanted it to be profitable. But in comparison to the market, at a 25 PE ratio, this is a very low PE ratio. So you're only paying $11 for $1 of earnings per share, but for the stock market average, you'd be paying about $25. So it's a very low valuation. Also, the forward PE ratio is pretty low, less than 30, so this is also good. But I would like to say I don't like how the forward PE ratio is higher than the trailing PE ratio. This just means that analysts expect the next year of earnings per share to be less than it was last year. So that's not a good sign to me, but I think if you look in the horizon to 5+ years, this company will be back on track. Also, the revenue growth is very good at 11%. Double digits is good, but the EPS growth has been going up only 1% because of the huge decrease in earnings per share over the past few quarters. So that's the biggest problem once again. But shares outstanding are decreasing at about 1% each year. That's pretty good. Debt to equity is a little bit high at 77%. but at least it's not more than 100%, because if it's more than 100%, that means they'd have more debt than their equity. So it's not a terrible debt to equity ratio, and it's not a terrible balance sheet, honestly, for United Healthcare. And analysts still expect this company to grow at 9% each year for the next 5 years, so they're still expecting decent growth out of this company. But that being said, going over to my intrinsic value calculator, I'm be using assumptions of the future to see if we should be buying the stock today and see if Warren Buffett is actually right in buying this stock. Now, looking at my intrinsic value calculator, I'm going to do a bear, base, and bull case for United Healthcare. And for the bear case, for the revenue growth rate, I think over the past 5 years, they've been growing at 11%. I think it's definitely going to slightly decrease from 11 or 13%, because year over year from its last quarter was 13%. So for the bear case, I'm actually going to do 6%. For the base case, I'm going to do 8%. And for the bullish case, let's do 10%. Honestly, this could be slightly off. And actually, let's do a base case of 9% and then a bull case instead of, let's do 12%. I think that's more fair, because the bull case should be a lot higher than what I think is going to happen. I think the base case will be anywhere from 8 to 10% for United Health. And for the bull case, that's literally what they did last quarter, so it's still not out of question. Just the hardest part for United Health is figuring the future profit margin, which right now, like I said, they're at about a 3% profit margin, but in the past, they've averaged anywhere from 5 to 6%. With the bear case, let's say they stay at this 3% profit margin, very low, almost its lowest it's ever been. For the base case, let's do 4.5%. For the bull case, let's do a 6% profit margin. Now for the future PE ratio. For a company that's going to be growing at 6%, I think this company definitely deserves a lower PE ratio than the market average. Right now, it's trading at about 12 or 13 PE ratio. I think a fair PE ratio for this company would be about 12, especially for a health insurance company. Now for the base case, I think a PE ratio of 15, and then for a bull case, I think 18 is fair for United Health. So now finally for the shares outstanding. They've been buying back at about 1% each year, so I think for the bearish case, say they buy back at only 0.5%. For the bull case, say they continue to buy back at 1%. And for the base case, say they buy back at 1.5%. With that being said, I get for the bear case a negative 4% return, but for the base case 12%, and for the bullish case 27%. So with these calculations, I think United Health still looks like a pretty decent buy today if you were to buy this company, as long as you believe that this company can get to a over 4% profit margin. If you think they can get back to where their profit margin was at, I think this is a good buy, and I think this is a good buy by Warren Buffett to add to this position. Very similar to the American Express buy back in the 1960s, with a scandal going on and just huge decline in stock price. Warren Buffett, I think, still knows what he's doing with buying this company. So thank you guys for watching this video. Please subscribe, hit the like button, comment down below, and thank you for watching.